Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, September 19th, 5:07 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we continue to be in a correction after the horrific downside move after the CPI data came out last week. Sorry, came out Tuesday. Before the market opened. You can see over here at the trend gauge, leaders still hanging in there. Not a good day for them today. I made the comment. In fact, the title of yesterday's insight video was the O'Neill conundrum: leaders holding up while the indexes flounder. But quite some red action in some of the stocks that have been holding up recently today. But we do have a baker's dozen that's held up better than the rest based on relative strength, and we're going to go through those charts tonight. So leaders still showing neutral. However, all 5 of the major indexes are trending below their short-term 21-day exponential moving average, their medium-term 50-day moving average, their long-term 200-day moving average. As far as what happened today, a post-CPI lower low, where we closed on the S&P at this key 3,900 level. We undercut it intraday, got back above it, faded right to 3,901 by the close, hanging on to that by a thread. Here are the numbers. G6, ARK-K actually up today. 9 of the top 10 holdings were positive. I don't know what's going on with that. But anyway, G6, this is our 6 ETF growth proxy. Somebody asked what the ETFs are. We're going to go through the charts of them today. S&P 5 that was down 0.62%. S&P 500 down 1.1, Nasdaq 100 down 1.7, Dow down 0.6%, mid caps down 0.6, Russell down 0.7, Global Diversified 60/40 Stock and Bond Index down 0.76%. We were positive in-house today, 0.14%. Booked our profits on SDS, and actually when we undercut 3,900, we for the second time we bought SARK, that's the inverse ARK ETF. We'll see where that goes. Losing stocks, and it's loaded with losers, don't hold up. If the market holds up, I can't explain why they're up today. Short covering maybe, but whatever. If the market goes lower, we would expect SARK to go much lower. We'll take a look at that chart also. Then we'll go through the tail of the tape and charts of interest. But first, let's get into why we do what we do here at Revere. I am going to show, first of all, a chart of the S&P 500, as I always do. What we do is trend follow here at Revere. We take our cues and how much we should be in the market by the health or lack thereof of the market. If you look back here in October of last year, the market was trending nicely higher above the short-term 21-day moving average. That's the green line. The medium-term 50-day moving average, that's the red line. The long-term 200-day moving average, that's the black line. If we start to roll over, go sideways, our stops are going to kick in. This is what happened recently when we had some longs on both rallies off of recent lows, but the market took us out. And if it really starts to roll over, you'll go below the 21 and the 50-day, and the slope of their moving averages will roll over. This is when we really start paying attention and get more and more defensive. And then if we break below the black line, the 200-day moving average, that's when all bets are off, and you know what chart I'm going to show if you follow us at all. That is the chart of the last 13 bear markets. I'm going to go through an exercise. I'm going to go through, starting next week, one of these each day, step through, take 12 days to do it. Well, 13 if I include the most recent one. Not sure exactly where we'll be by then. Might be making lower lows, but see what we can learn by looking at those charts together. And this is why our job number one is risk management at Revere. The last thing we want to see is somebody, anybody, whether they're a client or not, in their last couple of years going into retirement, face a very unfortunate sequence of returns where you can lose up to half or more of your harder nest egg. It's just devastating. And this is why we do what we do here at Revere, why we control risk, why we are active managers. And if you're interested in this approach, give us a shout. Email me, don@revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. So once we get out, like we had in mid-January when we first went below, we went above it a couple times. We went above it late January, early February, late March again, tried to make an attempt above it in April, and this is where we really failed. Took a really hard move down. This was on inflation data. And ironically, we just got inflation data, bad inflation data this week again. We also got bad inflation data here. So you got to pay attention to what's going on here. And just like we have rules for getting out, we have rules for getting back in. When we get back above the green line, we start taking a step into the market. We rode this up for not fantastic gains, but we're still above where we were when we started the process. But then when we start rolling over, this was Powell's speech on 8/26. A bunch of our stops went off here. When they broke below the 50, the rest of them went off. We added a little bit here when we got back above the 21. That lasted one day before the CPI data right here, and now making a lower low post CPI. Can't tell you how important this 3,900 area is. All the technicians are watching it. When we broke below it today, I was concerned we would have a waterfall. We didn't. We actually closed right on it by the end of the day. But that's our approach. Give us a shout if you're interested in it. Let's go through the rest of the indexes. Here's the NASDAQ 100. Actually weaker. This made a lower low and closed below these most recent lows. Bounced at the 290 area. The 290 is the equivalent of 3,900 on the S&P, so bounced a little bit there, making today's lows certainly critical. Let's go to the Dow Jones Industrial Average now. A little bit of relative strength this week, typical as this is a more defensive index. Tested the lows basically right there near the lows of yesterday, but lower lows post CPI and lower lows before the rally before CPI. Mid caps, MDY, not making lower lows here. Relative strength, you can see that by the line sloping higher, the RS line. Rejected at the 50-day moving average today as we were rallying up in the morning. Didn't make lower lows today. So again, some relative strength on MDY. Also relative strength on IWM, small caps over the last week and a half. You can see they haven't undercut that area as well. So that's where we are with the indexes. Let's take a look at, we'll bring up the tail of the tape and see how it applies back to the S&P and the NASDAQ 100. The technical headwinds join the macro headwinds as the indexes in the G6 had their stochastic hook down and the VIX is above 26. Got undercut it today, back above it by the close. 26 and above is where you want to be concerned. Put call at 1.09, fear and greed down to 40. Bear case reinforced today with the lower low. Some news, retail sales beat expectations, and the rail strike was tentatively settled this morning. Little bit of positive before the open, but we were negative by the open. Yesterday's day up now turns into today's day one down. I keep this counter because when you want to get involved, and once you reach day three, either up or down, the odds decrease that you're going to continue to go in that direction. So it's something that I keep in mind. Again, it's a secondary indicator, but today is day one down. Expectations coming into today were negative since CPI. Lower low was made, reinforcing that. As far as support and resistance on the S&P, closed right at the support area at 3,900. As far as 290 goes, we did undercut that and close right above it also. So we're near these support areas. I'll have this updated tomorrow for the next support level down. Strength today found only in banks, healthcare, and retail. Finished positive also. Negative. Oil's negative all day. Solar was sold all day. XLK, that's tech. XLU utilities, XLRE real estate were the laggards among the S&P sectors today. Recent leader uranium also sold today. So tan and uranium, this is the market coming for the leaders. Gold and gold stocks, not good today. Here's my focus list coming in. We didn't take any action on that. Some of these will be covered when we take a look at the survivors. As far as what we did in-house today, we took our profits on SDS when we undercut and then first recovered that 3,900 area. But then we broke back below it again. That's when we took the SARC long. So bottom line, post CPI lower low, hanging on to 3,900 by a thread. Must keep an eye on that. Here are the levels for tomorrow. The next level down is this, all the way down to this 3,800 to 3,815 level, which is the minus 20% year to date. Yeah, we could revisit that. And another 2% down, and this fib, this COVID minus 38.2 fib. So big area there. We got back above it on 715. That kicked off the most recent rally. Need to watch what happens. Still holding on to this level for now, this 3,900, the bottom of this range. Big level. So what's next? Let's get to the charts that I was talking about. And first we're going to bring up the Fab Five. These aren't sorted in the order that I want them to be, but let's just get through them. So the first two stocks I want to talk about are two of the dozen that have made my leaders list. If you were going to chop the leaders list down, here's why they're the leaders. Let's get back to them in a second, though. Let's do the Fab or the G6 first. So let me get rid of the stochastics. Note these all have the hook down. So that turns a temporary up momentum that we had off the low. It strikes it and you're going back down. In some cases, they've done the stochastic and moving average cross, and some they haven't. I'm going to take this off to make the charts a little bit easier to look at. So IWO is the first one. This is the Russell Small Cap, the first one of the G6. And this goes into the health of this G6 goes into us considering where we consider leadership and how leadership is acting. In this case, individual stocks are holding up better than the G6s. You can see IWO. This is the growth half of the Russell 2000. Can't get above its 21 and its 50-day moving average. So very clear negative there. FFTY, same situation, hanging around the 21 and the 50-day moving average, can't get above it. QQQJ, this is a mid-cap NASDAQ 100, got above the 50 and the 21 last week, gapped below it, and making lower lows since the CPI number on Tuesday. PDP, this is a Dorsey Wright Technical Leaders Index, also poked above the 21 last week, below the 21 on Tuesday, now below the 50 today. ARK-K, I mentioned how this is actually holding up better and with its positive day today, but it can't get above this 50-day moving average. So we've got a very quick stop out on this ARK-K, or actually the SARC, but we took it based on the ARK-K chart, although I will show the SARC chart here as that bounced at the 200-day moving average. So a break of this at the 200 will coincide to going back above ARKK's 50-day moving average. Either way, it's a good low-risk entry. And finally, MDYG, this is the growth half of the mid-cap 400. Again, you see it got above the 21, but gapped below it and the 50-day moving average on Tuesday, and making lower lows today. So those are the G6. Now let's talk about the dozen stocks that are holding up the best. And what you want to look at here is some are making higher highs, some aren't, some are near new highs. It's very difficult to make progress in higher highs when you're in a bear market. The best you can do is buy at a support area and sell the top of the range. So buy support, sell resistance. And that's a consistent theme you're going to see when we go through here. But really what we're looking at is these 12 all have a somewhat similar relative strength pattern over the last week and a half to 3 weeks. And this is what has separated them from the other 10 that were in, or the other 8 that were in the 21 over 21, and really a couple that aren't in there. But the relative strength line continues to hold up. I promise you it won't hold up if the market continues to go lower. They will get all of these, but for now, here's the 12 that I've identified. Enphase and CCJ. Again, note relative strength over the last 2 weeks, holding up. In fact, it's higher than where it was 2 weeks ago, despite the indexes definitely not being higher. But again, every time it tries to make higher highs, it gets knocked back down, and that's what's going on with the market. So you'll see that to a certain extent with these stocks, but you won't see them getting hit as hard, these dozen. So Enphase and CCJ, those were still flat because those were the last two that we held that we now sold. Here's the rest of the dozen. LTHM, again, relative strength going higher. Note, tried to break out last week, but we're in a bear market, slapped back down, but holding the 21. So the play is to buy around the 21, sell when you get up near the top end of the range. That's the best, pretty much the best you can do in this market. Tesla's holding up better than pretty much any of the dozen. You can see the relative strength here over the last 2 weeks. Tried to poke its head out today, but when the market reversed, it reversed also, but still closed positive on the day. Cheniere LNG, after upping guidance, made higher highs inside day to day. Again, there's the relative strength that we're looking for. Chipotle continues to make relative strength higher highs, tried to poke its head out before Tuesday, slapped back along with that, but holding up very well. Wolf tried to poke out today. Here's the relative strength over the last 2 weeks, reversed along with the market, but above the 21, and the relative strength is there. CEG, Constellation, alternative energy stock, solid relative strength. Can't really make any progress higher because of the market. BJ's, solid relative strength, tried to make new highs, reversed along with the market. First Solar, tried to make new highs, reversed along with the market, but the relative strength is there. ENVX, this is a new one, tried to make a higher high today, reversed. Look at the relative strength. It's really come on over the last week after going sideways after its gap up higher on earnings. And AEHR, thinster, but a strong stock. Relative strength this week after flatlining, actually a higher high versus recent action, but not versus 3-4 weeks ago when it was making highs. It pulled back, held the 50-day moving average. So those are the top dozen. There might have been a baker's dozen, might be 13 in there. But that's what's holding up the best. And but again, as I said yesterday, in a bear market, they will get them all. You better be quick to take profits or you'll be giving them back. That's going to wrap today's video. As always, love to hear your feedback. Don at revereasset.com. Phone 855-REAL-WEALTH. That's 855-732-5932. So wrapping up Thursday, September 15th, this is Don Vandenbord telling it like it is. Remember, it's not how much you make in the market, it's how much you can hold on to during bears. We like to get out of the way when we're under the 200-day moving average so that we can compound from a much higher asset base because we didn't have these big drawdowns that you can see in the indexes. Thanks for listening and have a great day.